Good morning and welcome to our Ashworth Wealth Weekly Market Update. My name is Scott Thomas. It's been a couple of weeks since I've done this, and in those couple of weeks, we've had a couple of pretty tumultuous weeks in the market. And I wanted to talk about that. Wanted to talk about what the problem was. I guess was 2 weeks ago. Last week was relatively flat, but I wanted to talk about looking forward where we think things are at and the relative strength in the market. This time of year, as we go into earnings season, gives us a pretty interesting glimpse into what companies think about where the economy is at. I wanted to read a couple of paragraphs or parts of a couple of different paragraphs from an article I read this morning. I wanted to share a graph with you. But this is talking about how companies are cautiously optimistic and why they're cautiously optimistic right now in the economy. It says the earnings season provides a unique perspective on the health of the economy. Continued growth requires continued spending, and management commentary or commentary that's coming out as companies are reporting their earnings offers insight into the two of the three sources of that spending, both consumer spending and corporate spending. There is cautious optimism companies have expressed over the past few weeks. There's been a slight uptick in mentions of an economic slowdown, and consumer spending is a bit more focused, while capital expenditures are less so. The changes are small, however, there hasn't been much chatter about job cuts, indicating overall concern is muted. Now, we are always concerned about when job cuts are mentioned, but the job cuts have not been mentioned very much as companies are reporting their earnings. And I'll show you that chart here in just a minute. Just one more thing, and I'll go to the chart. Balance sheets also remain robust and reducing the risk of something breaking. Consumer spending has been financed by real wage growth rather than borrowing. That's a huge plus, is that we are finally having real wage growth again, and that the continued spending has not been from borrowing. And companies are still spending down cash they accumulated during COVID. In the storm of recent volatility, investors should anchor to the fundamental truth highlighted this earnings season. Consumer and corporate spending is moderating but looks durable, so growth should be too. So that's kind of the topic of my what I wanted to present today, and I want to show you this chart here. This chart is showing that companies aren't really concerned about an economic slowdown right now. And what this is if you look on this first bit of information is economic slowdown, and it shows from quarter 1 of 22 all the way to today, and it shows where companies were at and how many of those mentioned economic slowdown in their reporting. And what you see is we're not having a lot of chatter, and companies are not really that concerned right now about economic slowdown. Also, consumer spending, that hasn't decreased much either, and companies are forecasting that consumer spending will continue on about like it has. This is a big one right here. This is actually one where it's good to have the big line there. This is capital expenditures. This is companies continuing to invest in manufacturing plants, equipment, all those kinds of things, and they are still spending money. That is a very good sign. And then this over here is job cuts. We are seeing that companies that were contemplating job cuts, that has actually gone down and is holding fairly even right now. So our feeling is that most companies have a pretty positive economic outlook going forward. And I think that's part of the reason why we had some big downturns here a week and a half ago, but then the markets came back and we've gained most of that back again. So let's talk about a week and a half ago, we had one day where we had about 1,000 point drop. It didn't end up that bad for the day, but there was at one point I think it was down about 1,050 on the Dow. What caused that? We had a couple of calls that day and the next day. Most of that was from jobless claims. So as the economy has a downturn, or we start heading into a recession or a downturn in the economy, one of the first big indicators is job growth or loss of jobs. So there was a report that came out where there was not as many jobs created as were supposed to, or what the economists thought there was. That was the indicator, and that kind of pushed the emotion in the market, and we had a big sell-off. Over the next few days, we had the same thing over in Asia, and it seemed to kind of implode on itself. However, because companies are not that concerned about things, and what we saw is we had a lot of consumers that were starting to sell off their holdings. institutional investors jumped right in and bought those stocks, and I buoyed those back up again, and we got most of those gain or most of the losses we got gained back. Let me also share a couple of things, kind of where we're at right now. Even though it feels like we've had a bad last couple of weeks, as of right now, the Dow Jones Industrial Average, as of yesterday, is still up about 4.5%. The Dow or the S&P 500 is actually up about 12.6%. And that again includes the last couple of weeks. So the economy is still continuing to clip along, even though we've had some stumbles along the way. Inflation. The last report on inflation was about 3% relative to last year, where it was about 3.3%. We continue to watch that every month as that number comes out. If it comes out as expected or lower, things usually, the markets will go up. If it comes out where that number is higher, that has been where we've had the markets go down. And so we're going to continue to watch that one very closely. The Fed meets again on September 17th and 18th. Now, there has been a little bit of change in most people's thinking about the Fed and rate cuts. When we had the big cut here, or excuse me, the big downturn here about a week and a half ago, there was talk that the Fed may come in with an emergency rate cut to kind of buoy the markets up. But when the markets have rebounded on their own and we've gotten most of those gains back, most of the feeling right now is it's kind of 50-50 depending on who you talk to. Most people feel like that we will have one rate cut by the end of the year. The Fed meets again on September 17th and 18th. So we're about a month away, and I would not be surprised at all, depending on how the economy goes, if it continues to go along like it is right now, that we may finally get one of the rate cuts we've been hoping for over the last year or so. Again, we appreciate the feedback that we get. We appreciate the questions that we get. If there's any questions on this or any other economic data that you have questions on, please give us a call or feel free to email us. And we have gotten some really good feedback and some good questions over the last couple of weeks, and we'll continue to address those. If there's a topic that you would like to have us go into, please let us know. We'd love to do it. So again, thank you for spending this time with us. And if you would like to share this with friends or family, we'd love to have you do it. And again, if you have any questions, please get a hold of us.